All right, so let's talk about wrap loans. And when we start, let's get clear about who are the players, who are the participants, who are the people involved. So let's make it pretty simple. We're going to have three people, three different folks, so on. We've got a civilian, an ender lender, maybe an institution, but I'm really careful about that anymore. Bank lines of credits rates have skyrocketed to double digit. Then we've got the wrapping lender in the middle, and then we've got the borrower, the owner, the property owner, whoever it is that needs the capital. So we got three distinct people here, okay? And folks, you, the investor, are the person in the middle. You would be the wrapping lender. Let's get started. Okay, the borrower needs money. Every day, I'm encountering borrowers that need money. I'm a borrower. I need money. I've got my network is coming through for me big time. I'm still about 2 million light on another deal, but anyhow, we're moving on. You're the investor. You locate some money. You found a civilian, you found an ender and lender, you found somebody else that's got money that's just wasting away under the auspices of inflation in a bank account, earning maybe 4 or 5% at best, maybe only 1 or 2% at best, but you locate somebody who's looking to make maybe a little bit more money. And you negotiate some terms. You negotiate what the borrower is willing to pay, and you also negotiate what the person with the bulk of the money is willing to earn on their money. You have a couple of conversations, okay? So there's some relationships here, folks. If you haven't figured out, relationships are important, okay? So then you loan a significant amount of money behind the first and build the spread into your note. That's the key here. You loan a significant amount of money behind the first and build the spread into your note. Now, I've seen people do something that I do not recommend. I'm going to preface this 4 times by saying I do not recommend this. I have seen people take $1,000 and wrap $99,000 with their self-directed IRA and think that that's legit. And I'm going to tell you that's not. Now, my buddy John,
it was not in a self-directed IRA, but in somebody's checkbook. That's how
even if it's checkbook, I don't think that's enough. I want to see 10% of the wrap. I want to see 10% of the funds coming from an IRA. If it's non-IRA money, go ahead. $1,000 can wrap 99.
That's what I meant was non-IRA money. Different bucket, right? Okay.
Yep, different bucket. If it's non-IRA money, you can use $1 to wrap $1 million. I don't care.
All right.
When it comes to IRA money, I want 10% in the deal. I want 10% skin in the game. My buddy John Heyer, he wants 20% skin in the game. So you figure it out, folks, okay? Now, is there any hard and fast case law, rules, regulations on that? No, it's a gut feel. It's what will pass a smell test? All right, so let's get into the players again, okay? The civilian, the ender lender, they have some money. They want to have their money working with little to no work involved on their part. The borrower, the owner, the property owner, they have a deal and they need money to fund the deal. And you're the person who has some money and you have a connection to both the property owner borrower as well as the civilian ender lender. You've got a connection with both of them. And so you can put this deal together. And let me give you an example of that deal. Okay. So we're going to put it all together. So we're going to give you an example. Your borrower needs $300,000. They're willing to pay 12%. They're going to pay $422.2 thousand over 72 months. Just take the interest and add it to the 300, and that's what you're going to get. You can put together a first position loan from the ender lender, the civilian, of $270. They're going to make 8.5% on their money. They used to be making 1 or 2% on their money in a bank account. Now they're making 8.5%. They think they have found the promised land. They are ecstatic.
8.5 is a nice return.
8.5 for somebody who doesn't know what they're doing is a fantastic return. Yep. Okay. Then you come in with $30,000 from your small Roth account and you wrap the 270. You notice I got 10% of skin in the game. Okay. And so you've got 72 payments of $4,800. That's their 8.5% rate of return. The same 72 payments are going to give you $1,065 with the very modest, low, conservative rate of return of 38.2%. That might almost be good enough to get Jeff Shahusky's attention.
Well,
Might.
I mean, at 38%, you're almost doubling every 2 years.
And that's my goal.
Is that even
That is my goal.
possible? Like, you know,
That
let's
is my
get
goal.
everyone's attention.
And Jim, literally the rule of 72 is the roadmap I use. My goal is to make 37% on my money when I'm wrapping. That's my baseline rule.
Jeff,
And
I'm not earning that much. I mean, you're making me think like, what, you know, why am I not?
well, okay, but Jim, it gets harder when you've got more money. All right, it gets harder.
I
Okay.
understand, but it's
All right.
especially if you have like an inherited IRA or something.
Yeah, inherited IRAs. This is where I just go crazy. I would just go absolutely aggressive on those. But anyhow, but you take a look at this situation. Now I'm going to put a diagram on the screen to help you better understand what we're doing structure-wise. Okay. So what is a wrap loan? You've got an underlying first of $270,000. You've got a second of $30,000 that wraps or encompasses or encases or includes the 270. Because it includes, that's why we call it a wrap. So what's the total amount being loaned is $300,000. Earning, the borrower is paying 12% on it. But the 270 is only earning 8.5%. So all of the upside potential goes to the 30. So the 30,000 is making 12%, but the holder of the $30,000 note is also getting the difference between the 8.5 and the 12. So I'm making 3.5 on 270 plus 12% on 300, on 12% on 30. Not a bad day. Not a bad day. Do a couple of these a month and you're going to be doing really well.
Can everyone see how this is like, we always think about leveraging, like when you borrow from a bank to buy a rental. In this case, you're being the banker and you're still leveraging. Does everybody catch that?
You're creating leverage in a non-UBIT manner. A wrap in this manner does not generate UBIT because the IRA with the 30,000 did not borrow the 270. It co-lent the 270. It came along beside and behind the 270. So there is no UBIT if you're using an IRA here. All right. Let me move to my next slide. So let's give a different example here. Okay. Different example. Okay. Civilian Ender has $150,000 she's willing to loan out at 9.5% interest. Okay. The investor has a home he wants to purchase. He needs 160 to fund the deal. Willing to pay 12% on the money. The wrapping investor has 10K and the connection between the two of them. Okay. So let's put this deal up on the screen and work it out a little bit.
So if
So how is
somebody has
this?
$10,000,
Right.
you're a little light to do the full 160. So you bring in a financial friend or partner for the 150.
Correct.
And you come
So
together on this.
We've got the let me get back to this. We've got the underlying 150 earning 9.5%. We've got the whole 160 earning 12%. So the person who's taking the 10 and wrapping the 150 is making 12% on their 10, and they're making the difference between 9.5 and 12 on the 150. Once again, not a bad day, not creating and generating any UBIT. We're wrapping and we're co-lending and we're originating both notes at the same time. We're originating both mortgages or deeds of trust at the same time. And that's where we are. Now, let me put the next thing up on the screen. So we're going to look at what's the Civilian Ender's position. 72-month loan, 9.5% interest, $150,000 lent. They're going to receive a payment of $270.4120. Everybody's happy. All right. So, but the wrap investor is collecting a payment of $3,128.03. So if you take the total loan amount at 12%, amortizing over 72 months, the payment on that is $33,128.03. They remit to the other lender that put in the 150, they remit 2741.20, $2,741.20 to the underlying lender in first position. Okay, so I collect one payment. From that payment I collect, I then pay out to my wrap lender their portion, keeping the difference to me. Okay, so the $10,000 over 6 years grows to $27,850 over a 6-year period of time, which is a 42.66 rate of return. Is that good enough?
Oh, well, of course.
Oh, I
42%.
know, but I'm just
I'm not
asking the question.
making that.
Well, anytime you're making, anytime the rule of 70, yeah, anytime you're making more than 18%, I think you're doing great. All right. So let me get into
outstanding, yes.
Let me get into some technical stuff here, and then we'll get into some of the I think there's probably a flood of questions, but we'll get into the technical stuff and then have fun with it. All right, so let's talk about the stuff that no one else talks about when it comes to these wraps. And that is explaining it to a title company, because title companies don't see this on a normal basis. Title companies get confused. And I find that when you explain it to them in the form of a closing instructions letter, they begin to figure out what's going on. So part of my closing instructions letter, when I'm putting together a wrap deal, is that the first thing that has to get recorded is the deed from the seller to the buyer. Should be recorded first. We always got to get the deed recorded first. Then immediately following the recording of the deed, the first position mortgage, or if you're in another state with a deed of trust, the first position deed of trust from wherever that underlying lender is for the 150 is to be recorded. Immediately thereafter, the mortgage in favor of whoever's putting up the 10,000, it gets recorded for the $160,000 wrap mortgage. So we go deed, first mortgage, wrap mortgage, in that order. The deed first, the first mortgage, the wrap mortgage. In that order, they have to be recorded. I explain that to the title company. Does that always work? No. But most of the time it does. If I don't explain it, they don't know what they're doing. They get all confused. So let's talk about this. So how much does the borrower really owe? Because somebody's going to be looking at me and go, well, Jeff, we're recording two mortgages, one for 150 and one for 160.
It does confuse people. I've had title companies ask me that.
Oh, I don't want to embarrass, but I was working with a former client and he was going to make a wrap loan and the attorney for the borrower couldn't understand it.
Yeah.
The attorney for the borrower, and I was like, you went to law school, right?
But he didn't go to economics.
You know how to read, right? You know how to read, right? You understand English, right? Well, you know, because what they couldn't do is they couldn't understand the language I'm going to show you in just a minute. So how much does the borrower really owe? Do they owe 160 that they're paying 12% on? Or do they owe 310? I'm going to tell you, if you don't know how to read, you're going to think they owe 310. But if you know how to read, you're going to realize they only owe 160. But I've seen attorneys and title companies not be able to read. So let's get into what they can and can't, what they can't read, but what they should read, okay? So this is a sample of an addendum to a note that I use in an IRA situation, okay? So let's say Quest Trust Company, comma, custodian, FBO, Jeff Watson, IRA, 1, 2, 3, 4, 5, 6, 7, and Build Bigger and Better LLC, dated whatever, okay? So Build Bigger and Better LLC is lending the 160. My IRA is coming in with the 10% more. Boom, we're going on, okay? So just read this note very carefully, and I want you to see what I put on the screen here. Payee herein. So who's the payee? The payee is the IRA, okay? By acceptance, this note acknowledges his or their duty to the payor herein. Who is the payor?
Person
The
making.
payor is the borrower. To pay any obligation that may be owed, which is evidenced by a note of even date given in favor of the underlying source of money right here. Everybody see how my cursor is going back and forth? This is where describing the underlying source of money. Okay? So payee, once again, specifically agrees that in the event said obligation becomes in default where the payor is not in default. What does that mean? That means if you're collecting money on a wrap and you're not satisfying the underlying, you're in default, even though the payor is paying on time. Then the payor shall then have the right to pay whatever sum is required to remedy default, and such sum expended shall be credited against any installments due hereunder as they mature. Which means if you collect money on a wrap and you don't remit to the underlying, and the borrower finds out, the borrower can stop paying you, pay the underlying directly, and tell you to pound salt till they have to finally owe you some more money. Okay? And the payee acknowledges that it's their duty to take all necessary action to present any foreclosure of the above mortgage and to obtain satisfaction of the mortgage no later than the maturity of the original indebtedness secured, blah, blah, blah. Okay? I put this language in here so that it's clear that when the borrower signs this note, they're like, oh, the person I'm paying on this note has the duty to make the payment on the other note that I'm signing. I'm going to say that again. When the borrower is signing both promissory notes, the second note says that the person that they're paying on the second note has the duty to make the payment on the first note. So let me jump back. I want to make sure everybody sees that because that gets people so confused.
It really does.
So let me make sure of this.
So that's an addendum to the promissory note?
Addendum to the promissory note.
Okay, I like it. I haven't seen that. I like it.
Let me see if I can get to the right slide. Where is it? Where am I?
Maria, I
Okay,
see your
right here.
question. We'll get that in a little bit.
Right here. Okay. So on this scenario that I talked about, the wrapping lender receives a payment of $3,128.03. From that $3,100, they have to pay $2,741 to the underlying lender, the other investor lender. Okay, so they only get to keep that 400 some odd dollars spread. But at 400 and some odd dollars a month over 72 months, they get back their 10,000 and they get back another 17,850 on top of it. That's the key element I want everyone to understand here is that the borrower should only make one payment. You as the wrapping lender should receive that payment and promptly from that payment satisfy the obligation to the underlying one. So I've got a deal right now that it's a wrap loan running this way. It's been running since pre-COVID, and I check on a regular basis to find out when does my borrower pay, because right after that, I got to send a check out to the underlying. Okay. All right. Let's get into this a little bit more. I want you to see this language. Payee herein by acceptance of the note acknowledges his or their duty to the payor herein to pay any obligation which is evidenced by a note of even date given in favor of the underlying lender. Okay. I'm going to leave that on the screen because I want you to see where that says, because the payee is the wrapping lender by acceptance of this note acknowledges their duty to the payor herein to pay any obligation that may be owed on a note of even date. What does that mean? That means the original note of the 160 that we wrapped.
Jeff, can you
Okay.
go over payee, payor one more time, just to make sure everyone's got it?
Sure. So the payee is the person who is collecting the payments. In this instance, it's the wrapping lender is the payee. They're the ones receiving the monthly or quarterly payments. The payor is the borrower who is making those payments. And when they're making a payment on a wrap loan situation, they pay the wrapping lender. The wrapping lender receives the payment, and from that payment makes the payment to the underlying or wrapped loan.
So let's do this, Jeff, real quick. Let's say that you and I are gonna do one together. I'm gonna put my funds up at 9%. Okay?
Okay.
90% of the funds needed for the loan. You're gonna put up 10%. You're gonna take in 12%. So
Okay.
who's the payor, payee? Where does the payment go, and how does it end up to both of us?
Okay, so you're putting in 90, I'm putting in a 10. We're making $100,000 loan to Jeff Shahusky because I'm picking on Jeff today. So Jeff's going to make a payment of $1,200 a month to me. Okay.
All right.
Out of that, I'm going to collect, out of that $1,200 I collect, I'm going to remit $900 back to Jim. Jeff Shahusky is the payor. Jeff Watson is the payee, and Jim Ingersoll is the holder of the note of even date that is the underlying wrap amount of 90.
Did that help everyone? I think it helps when we have real people.
It does. So go back. Let me do this. Let me go back to the let me go back to one of the beginning slides. I'm going to just make everybody's eyes blur and hurt for a second. Okay, right here. See where these arrows are going? The property owner borrower has the money. They've gotten the money now. They make a payment to the wrapping lender. See that arcing arrow? They make a payment of $1,200. Jeff Shahusky here makes a payment to Jeff Watson here. Jeff Watson makes a payment to Jim Ingersoll over here. Jim Ingersoll lent 90,000. Jeff put 10 into the deal. Shahusky borrowed 100 and is at 12%. Making a $1,200 payment here, $900 goes over here. Watson pockets 300, Ingersoll keeps 900, and Jeff has the property or the deal.
Yes.
We good on that?
I would like to do that deal.
So would I. I'd like to collect checks from Jeff Shahusky rather than have to send him money. Oh. I am certain that the payoff on my loan with him has just gone up.
But I like your money, Jeff. It's
Yeah,
good. It's good, qualified. It's just like having a competent attorney. You have competent money.
Okay. Oh, folks, this is so much fun. Okay, now I'm going to show you one more document that hopefully will help you understand. This is the second part that the attorneys and title companies don't read and don't understand. This is in the mortgage. Remember, this is in the promissory note. This is the addendum to the promissory note. Now we also have it again in the mortgage or in the deed of trust, but I'm doing business in mortgage states. So this mortgage is given a secure payment as evidenced by a certain promissory note, blah, 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 blah. Okay. This mortgage is subject to a mortgage in favor of Jim Ingersoll, dated of even date and recorded immediately prior and senior to this mortgage in Ashtabula County, Ohio. Actually, I should go Green Bay. I should just say Green Bay County, Wisconsin, because that's where Jeff Shahusky's hanging out. Okay. The indebtedness reflected in this mortgage includes the indebtedness in said mortgage. The indebtedness in the $100,000 Shahusky to Watson mortgage includes the $90,000 indebtedness of Shahusky to Ingersoll. But people don't understand words like prior and senior to, or subject to, or includes the indebtedness in said mortgage. But we go on. Therefore, the grantee herein, which is the person, which would be Jeff Watson, by acceptance of this mortgage, does specifically agree to pay any payments due pursuant to said prior and senior mortgage, according to the terms of said prior and senior mortgage, and the notes secured thereby. So once again, this mortgage for $100,000 given by Shahusky to Watson is subordinate to and includes the $90,000 mortgage given by Shahusky to Ingersoll. Which means that when Shahusky makes the payment to Watson on that mortgage, Watson then has to take from that payment and make the Ingersoll payment. And as we talked about the example in the numbers, there's a $1,200 payment from Jeff Shahusky to Jeff Watson. And from that $1,200, Jeff Watson gives $900 to Jim Ingersoll.
Yeah, see how the money's sort of flowing along?
So hopefully we've made it as clear as mud that is settling to the bottom of the pool. And so people can see that this is a very powerful way of supercharging rates of return on some smaller sums of money. And you notice I use examples, $30,000, $10,000, not a lot of money. Okay, not a lot of money in the scope of things. So this is a powerful, powerful thing, but I'm going to tell you, you have to be able to comfortably explain this.
That's the hard part.
And you have to be able to point to paperwork that says, hey, when Jeff Shahusky makes the payment to me, out of that payment, I got to pay Jim Ingersoll. So that Jeff Shahusky is like, okay, so if I make one payment to Watson, that includes the payment to Ingersoll. Yes. So I'm not making two payments, one to Watson for $1,200 and another payment to Ingersoll for $900. No, you're not paying $2,100 a month. You're only paying $1,200 a month, because out of the $1,200, I got to pay $900 to Jim. And when I've explained that to borrowers, the light bulb finally comes on and they say, okay, I get it. I'm borrowing this much money. This is what it's cost me. That's what you told me it was going to be. I go, yep. But this is the way that we're putting the deal together. Okay. And they go along with it then. And that, my folks, my friends, is the end of the slide deck. So I'm going to stop the share and